The chart in front of us is that of the Nifty 50, and the time frame that is set is of the daily. We will note that from its high on 27th of September, today Nifty has for the first time closed below 22,800. And this is the lowest low that the market has created since the corrective phase began in late September last year. The reason why this low does not augur well is largely because if I simply include the OBV, which is the on balance volume, we will see that even though on the surface it looks like the market has formed a double bottom, the volume has gone and created a new low. What this typically implies is that obviously there is increased odds of a gap down on a Monday, and a gap down after sorry and a gap down after nearly a week of consolidation on the surface will look like a breakaway gap, but breakaway gap requires significant volumes. And if I include the normal volume chart, we will see that the volume at which the market has been trading is typically below its 20 period average. So we are obviously not seeing that kind of volume, but the distribution is apparent, and that greatly increases the odds of a gap down on a Monday. So what would a gap down on a Monday imply if it were to actually happen? We must understand that the sharpest reversals happens from gaps. So if there is indeed a gap down on Monday and you are carrying long positions, you would want to actually wait for some time to see if during the day the market actually comes above the low that was created earlier. That's 22,730. So let's assume there is a 1 or 2% gap down and the market opens at say 22,650 and it rushes a little lower. One will have to wait for some time to check that during the intraday rally if it actually breaches above the previous low of 22,730. That's largely because in the event it does so, it triggers intraday reversals, and any closure above this low would form a very bullish reversal candle. This needs to be factored. That's largely because one is anticipating a gap down after a very red closing on a Friday. So Friday closings are always very important because it is a decision of the market to close the week at that level. So this will obviously unsettle many longs over the weekend. But that is that. One has to expect that there could be a gap down, and one has to wait for some time in order to assess the volatility of the market on the potential upside. Another key point to note is that whenever we are checking the price of the market, we should typically try and see how the market behaved when it was in a similar zone in the past. So a gap down would obviously imply that the market is coming somewhere here, where I'm just making a horizontal line, which I will darken, make it a blue line. And here we go. So a gap down would logically imply that the market is coming somewhere here, and this has been a region of strong resistance in the past. So if I were just to take this time frame somewhere here, we would, that is assuming some gap down. So just if I correct this, so you will note that this 22,750 has been a region of extremely strong resistance in the past, and this is the election. So it is after the election, and if I include the volume here, you will note the size of the candle that is formed, which is a typical anchor bar. So after a lot of volume, a decision was taken by the market to take out this high. So therefore, if the market has to breach this low, that will come as an that will come as a huge surprise, because there was a lot of consensus in the market when this low was defended, and the market rallied forward. Also, we can see that this previous zone here is basically a resistance zone for the stock at that time. We can see a top here and a failed breakout attempt as well. So this is obviously a resistance zone, and eventually this resistance zone where the market spent considerable amount of time, which would imply from April 24 till June 24. So this is approximately 3 months of resistance, which is quite significant in the context of trading. And currently, as we see the price pretty much at the previous resistance, we should um, we should look at it as a potential area of support also. This does not mean that we buy right away. That's largely because the previous buy signal that the market would have given was the W pattern with the divergence that was formed and broken out, which has obviously got which has obviously it's not supposed to create a new low after that as per the pattern, and if that new low has been created, then the pattern is obviously violated, which would imply that one cannot buy right away, but one has to be on the lookout for potential sharp reversals in this rather quite a large zone, because this was the candle that was created on the election, and this is the candle which we were referring to had extremely high volumes. So, but within this zone, somewhere in the midpoint, around these levels, we must be on the lookout for a potential of a reversal. So, which means that here again, once the market comes in this zone, we will again have to assess for tactical reversal patterns, which have so far not held. Which have so far not held. For example, if we come here, we would note that right here we have a bullish harami, and the close here confirms this harami, and subsequently the market created a new low. Later on, the market created, so say for example, if I was to take this here as a lower top, the market breached the lower top, and now the question is, would the lower bottom, the previous lower bottom, hold? So the market breached the lower top, creating a temporary higher top, and the expectation or the hope from the long side would be that there will be a higher bottom, but unfortunately it has closed below the previous low, and it has done that with distribution in volume, increasing the odds that will create a lower low on the pivotal. So we will have a case of a higher top and a lower low, signaling a potential range, which means that the market is now going to clarify the length of the new range that the market is likely to enter. So while it looks very bearish, and it is not the best of Friday closings. So while it looks very bearish, one should just be a little cautious before selling. If I also add some longer moving averages, for example the 50 and the 200, and I remove these horizontal lines that have been created in the past, obviously we see that there is a bearish crossover on the 50 period moving average, and there has been a test of this 50 period moving average, and that is this is the first throwback after a new low was created since the crossover. And here after this, if a new low is created, it doesn't augur well, then the 50 period moving average permanently becomes a resistance for the market, and it typically takes the market several weeks or months in order to breach this resistance. This is quite a strong resistance, because immediately after this we will find the 200 period moving average, which will become the resistance for the market at this time. We'll just have a glance on Nifty on the weekly, just to see what it forms. So nothing too encouraging on the weekly either. We will see that there is a doji close. A doji again signifies uncertainty. Like we mentioned, that the close is below the low, which is never a good sight. And we are obviously hoping that in the event there is a Monday morning gap down, if that actually happens, then that will be a gap down even on the weekly charts. And if in the week the market closes in the green, say for example above this, so which would mean that what we discussed on the daily, if that is to be that would be extended even on the weekly if the gap down happens on the Monday and the market recovers and closes somewhere around these levels. Obviously having a 200 moving average would be quite redundant on the weekly for now, but if you look at the 50 moving average, we will see that the market is already trading below that, signaling that at best it is a bullish weak stock, with the longish consolidation periods which are ongoing, and the all supports previously will now become the new resistance, which we will assess and identify on the daily. So after this gap down, of course, every point that was previously acting out in support of the market will start becoming new resistances for the market, and they will typically coincide with the 200 period moving average, which means this 23,800, 23,250, etc. These are all going to become strong resistance points in the market. But with the gap down, even though there could be a thought that one would short 23,250 calls or 23,800 calls, but if there is a gap down, you'll get absolutely no risk premium, and it will not justify perhaps taking that trade. So, point being that It looks like it is going to sell, uh, but there hasn't been a sufficient rise in this phase of consolidation to think that a lot of selling is likely. There was obviously a satisfactory rise till 23,800 from where we did see sharp selling. So we will have to see if what earlier looked like a series of exhaustion gaps, because if we see closely here, that after the formation of a doji, every green candle that is formed has been based on a gap down, that the open was a gap down and there was a recovery in the market after that. So which means that sellers become slightly impulsive and sell off first thing in the morning, and there are people who are buying what they do. Now the question is, would this gap down then being bought pattern even continue on a Monday? And would it continue if the gap down is sharper? Because here what we are seeing is that the gap down, for example, here Nifty closed at 22,930 and the opening was at 22,800. So there was a 130 point gap down and it was bought, and this process was repeated for some time. Now the question is, what if there is another 130 point gap down from here at 22,650, 22,660? Would it be bought back by the market at that time with the same enthusiasm? And what if it's more than 130? What if it is, say, another 130 points, which would make 23,520 as the zone of gap down? Then would it still be bought with that level of enthusiasm, which remains to be seen? If that confirmation happens, because after the gap down, if there is a green closing on the daily or if there is a green closing on the weekly, then it once again forms a very bullish reversal candle. And since we have long discussed that the trend structure on the monthly is intact, we are looking for confirmations on the smaller time frames to take the decision of going long heavily on the market. And obviously anyone who went long heavily in the market prior had to pay the price. That's largely because the market simply did not respect any low, and in the process has created, let's say for example, a good 20-22%, maybe different indexes have corrected differently, but in the Nifty, as we can see, that from 26,000 levels to dip below 23,000 levels, and to do it so effortlessly is obviously going to take many by surprise. On just to add that on the weekly, this price action looks very similar, so I'll just eliminate these points here. On the weekly, this price action looks very similar to the Russia, to the so this phase right here. I think this is not the best. This is not the best. Perhaps this may be slightly better. So this is the Russia-Ukraine phase of the markets that I have marked right here. This is what we had in that period 22, uh, and we can see that. So I'm sorry about this. Yeah, and we can see that even here the market had created a high at that time of 18,600 and went all the way till 15,000. So that was near 16-17% correction on the index, compared to which right now, if we are to look at this structure, so if I just drag this same, or try to drag this box right here and just a different angle. Now compared to that, if I were to look at this structure, the market is forming this consolidation after the Russia-Ukraine war. Perhaps maybe there is more to the Israel-Hamas conflict that meets the eye. Perhaps that conflict is going to take a wider structure, and and once this structure resolved, the market had a very decisive trend. Now, obviously, we can see that even during this phase, after a bullish engulfing on the weekly, after two easer bottoms on the weekly, the market did gap down, create a new low, and then eventually went on to nearly go all the way to the previous high. And this is the past this past tendency of the market is forcing traders to look at this consolidation in this manner, and to see if there is a gap down and what if the market goes testing towards the previous levels. But obviously each pullback phase is different, but everyone works out of a certain precedent. And at this point in time, if anyone is having a long view on the market, it is obviously going to be from the perspective of value buying. And very few people, if the market actually does create a new low, and eventually if it were to actually break this 21,500 level or 21,900 level where it was, that is this 21,250 level, if it were to actually break this, this would be very, very bearish. Not bearish, I mean, it would be very negative from the perspective of investing, because then the market would have this still is a pullback on an uptrend, believe it or not, despite the extent of this pullback. This is still a pullback on the uptrend, because the clear previous reference low, without any ambiguity, will be this one. This was the higher bottom at that time, and we have checked already that this was a higher bottom formed out of a lot of volume. So we know that this level is significant. Now if the market is to correct another 3 or 4% and at this level form what is known as a double bottom, then the structure itself would become range bound, very deep range on the weekly, and markets can spend several years within a range. So it is not to say that buying strategy would not work then, but the buying strategy would become very would be applicable to very select few stocks. The market breadth would become very narrow, and it'll focus and the trading strategy will largely be revolved around having a tighter watch list and a greater concentration of positions if this were actually to happen. So this is just the thought process as I am seeing the chart, which I thought I would share with you. I hope you all have a good trading week ahead. Take care.